Now, while Africa is only responsible for around 4% of global carbon emissions, the continent will be most negatively impacted by climate change repercussions. According to Boston Consultancy Group, by 2030, a $2.4 trillion investment is needed to meet Africa's climate needs. And with under a decade to go, just 12% of that need has been met. How do we close a substantial gap in climate financing? While we speak to Katie Hill, who's partner and Associate Director of Climate at BCG Nairobi. Thank you so much for your time, Katie. Good afternoon.
Thank you for having me.
All right, Katie, we are speaking about trillions of dollars here. It is a staggering amount. Please help us put it into perspective.
Sure. Now, it is a staggering amount, but it's also, an achievable amount when you look at the economic opportunity that comes with it, right? So we talk about why is this an imperative? It's an imperative, as you said, because Africa will be most negatively impacted by climate change. But it's also a huge economic opportunity with new industries being built across the globe and many African countries having a number of comparative advantages in these industries when you think about renewable energy capacity and critical minerals and so forth.
I'm also keen to speak about, I guess, from the perspective of the continent, to ready ourselves for this kind of financing and the magnitude of, the projects that will emerge here. It speaks about, regulation. It speaks about capital markets and the likes. Katie, where are we in that regard?
Yeah, the biggest deterrent of capital flowing into the continent is macroeconomic uncertainty. And, we've all lived through that in the last few years. As you said, I'm based in Nairobi. That's been home for me for many years now. And we've gone through the inflation, the currency, currency devaluations. But one of the biggest tools here is simply predictability of policy. Around the world, you have a lot of governments that put in place strong incentives for renewable energy and green industries. It's understandable that a lot of African countries cannot necessarily put in place large subsidies here. We have other major problems to solve, but what we can do is have very predictable policies around taxation, regulation, license approval, and so forth, so that capital can feel comfortable coming in, and because these are often long-term investments, right? 10 years or longer investment horizon for returns in renewable energy or green hydrogen or electric mobility.
Also interesting then, let's speak about what investors want, because, investors don't invest anywhere unless there's guaranteed ROI. And that could also be, I guess, a difficult place. Like you're saying, predictable policies around taxes and the likes, that helps in being able to model at least some form of ROI. But then we still need to be able to, let investors know that if they put an X amount in on the African continent for 20 years or maybe even more, there will be something for them at the end of it, Katie. And how do we do that?
No, I think on a case-by-case basis, that is happening. You see a number of new, despite the headwinds, you see a number of new African asset managers that have been coming, raising new funds. You had last week Africa Infrastructure Investment Managers that closed a $750 million final close for their fund. You had Helios's new climate fund that reached their first close of 200 million. And so, the challenge is that it is not that it is not happening. It's just not happening at a large enough scale. And so, as you've put it, quality of the projects are important. But one of the other big challenges here is the cost of financing. And I'll specifically say the cost of debt financing, because these sectors require significantly more debt often than other industries that you might imagine operating on the continent. And you see a 20-30% plus cost of debt financing, which makes it really hard for these projects to break even, to recoup their capital, to return capital to equity investors. And so we've looked at a number of instruments and tools for bringing down the cost of debt, which I think is one of the biggest opportunities.
I want to speak about that because, of course, we are speaking about these lower interest rates, now specifically where we are, Katie. But we're never, I think, going to see money as cheap as it was back in the day. I think that's certainly back in the day and now when we speak about it. So, I mean, even if interest rates fall, it won't be these steep cuts. And, of course, capital still needs to flow. Let's talk about the cost of capital and managing that.
Mm-hmm. Yeah, and we know the reasons why we see high cost of capital here, right? And there's some good data around it. But, we did an analysis looking at cost of debt for climate projects on the continent versus other emerging markets. And, you're in South Africa. We found that, South Africa, compared to Paraguay, which is a country with a similar GDP per capita and the same risk rating from S&P, is actually paying 5 percentage points higher on average for debt. That is a really significant jump. Now, the default rates are higher in the region, so we can understand where that is coming from to some extent. And so a big part of the solution is disaggregating and finding the projects that have strong underlying fundamentals and ensuring that they're getting the lowest cost of capital to start building momentum for these industries. And so you do have a number of obviously development finance institutions and climate-oriented investors that could use a range of instruments ranging from, the more traditional instruments of green bonds and first loss capital and loan guarantees to more novel instruments around, partial FX guarantees, debt for climate swaps and so forth to help bridge towards, the future we want where we are seeing lower cost of financing.
Okay, definitely interesting chatting to you today. Thank you so much for taking us through this very interesting one today. That was Katie Hill, Partner and Associate Director of Climate at Boston Consulting Group in Nairobi.